All right. Welcome back, everybody, to another episode of Junior Resource Investor. This is the podcast that's dedicated to deepening your understanding of the junior resource sector and some important and exciting plays within it. I am your host, Matthew. Just a disclaimer, right? This is not financial advice. Neither myself nor my guests are financial advisors, and this podcast is for entertainment purposes only. For full disclaimer, please check the YouTube notes below. Also, a reminder that there is a companion analyst report that I put out for all my interviews. A link to that document can be found in the YouTube description for this video. Today, though, I am pleased to present our latest guest, Abraham Drost, CEO of Clean Air Metals. Clean Air is a platinum group metal explorer and developer operating in the Thunder Bay region of Ontario and Canada. It trades on the TSXV under the ticker AIR, AIR, and on the OTCQB in the States under the ticker CLRMF. A reminder that, nice to see you again, Abraham. Thanks for coming on the show. How are you doing today?
Oh, doing very well, Matthew. Thank you. Nice to be here.
Yeah, no, thank you very much. I guess this is where we kind of started prior to recording, but you folks, well, we better start here, right? Some exciting news coming out today. You had some infill assays come back that looked very promising. Do you want to just kind of touch on those briefly?
Yeah, the Thunder Bay North Critical Metals or Minerals Project has two deposits in it, both of which are expected, according to the results of a PEA filed in January, both of which are expected to supply feed to a single mill. The two deposits are the Escape deposit, purchased from Rio Tinto, and the second is the Current deposit, purchased from Panoramic Resources of Australia. We now have a full mine plan developed on both assets, feeding a single surface milling complex. These are underground ramp access type operations. But to your question about the press release this morning, we published some additional results from the Escape deposit, drilling results, and also some metallurgical bulk sampling results from Current in preparation for our pre-feasibility level metallurgical optimization that's taking place. The results are, again, they're what I would describe as normal course, but they're peer leading grade. They're high grade results, and certainly we think the Thunder Bay North project has a bright future on that basis.
Mm-hmm. Yeah, peer leading grade is a good way to put it. I'm going from memory here, but it was 2 grams platinum, 2.5 grams palladium, 0.8% copper, over 19 meters or something. So no, that's not a bad little assay for sure. Yeah.
And that's very consistent. I mean, your viewers can go back through our news flow at cleanairmetals.ca and just look at the headline drill results from inception. This project has held up extremely well.
Yeah, absolutely.
Mm-hmm.
Well, anyway, let's kind of get back on track to my formal questionnaire here. I always try to start off with a brief discussion about just macro events, right? I mean, geopolitics today seems to be casting a little bit of buoyancy into the precious metal sector with Nancy Pelosi's visit to Taiwan. The market, 20 minutes from close here, all my junior explorers are having a healthy day. I guess personally, even notwithstanding this little bounce we're getting, I'm still nervous that maybe things are still frothy and there might be some air to come out of the balloon a bit yet. What are your thoughts, I guess, on where we are on the macro level?
Well, if we're talking macro potential for conflict, additional conflict, I think we live in very dangerous times. If we're talking macro in terms of the implications for the precious metal suite, I think that bodes well. I think we are in times of uncertainty, and at the end of the day, U.S. dollars had a pretty good run here, and looks like it might want to correct to the downside, which I think will be good for the pricing in the precious metal suite. And when we say precious metals, of course, we're probably fundamentally talking about gold as a safe haven. But let's face it, palladium has been higher than the price of gold for some 3 years running now.
Mm-hmm, mm-hmm. And it's hard to, globalization seems to be fraying a bit, right? Nationalization of resources and that kind of that nationalization of critical minerals and critical metals, which is a big part of the bull thesis for me for clean air, right? So.
Absolutely. It is interesting to note, for example, with all the sanctions that have been imposed on Russia, given the situation with Ukraine. That does not include the Norilsk deposits run by Nornickel, because they are just too important
Hmm.
in terms of the world's economy. That is specifically the automotive sector. We in the West cannot build automobiles or cars without gasoline, fossil fuel burning cars without a steady source of palladium. And so the palladium supplies have not been cut off. And so from that perspective, you know, it's a little bit business as usual in the sector. It's the extent to which any kind of recessionary forces will be imposed, which makes that a little bit of a tough bet. Or increasing sanctions. Could we actually cut off our nose to spite our faces here in the West? Theoretically, we could. We've already done it significantly, and the folks in Germany are going to be feeling that this winter.
Hmm. Yeah, was it Belgium or the Netherlands? I hear that they're recommending wood for burning wood to
Ah,
keep yourself warm in the winter. So, yeah, pre-industrialization. Anyway, why don't we just circle back here? If you don't mind, why don't you try to give my audience a 30-second elevator pitch on clean air, on air? Why is it compelling? Why should investors care? You just want a kind of little introduction for us?
sure. Well, I mean, I guess I'll speak from my own perspective. I'm 35 years geoscientist. I've worked pretty well my entire career in the gold side of the business. And I was offered the opportunity to come aboard with this opportunity that we now call clean air metals around the consolidation of these two very promising platinum, palladium, copper, nickel assets here in northwest Ontario near Thunder Bay. We call it the Thunder Bay North Project. From my perspective, proximity, sort of, you know, geo, geo, in terms of political stability, and also mining friendly jurisdiction. In my backyard, I live in Thunder Bay. Made it kind of a bulletproof kind of concept for my involvement personally. But when we talk about peer leading grades, proximity to infrastructure, 30 kilometers from the city of Thunder Bay, which is a mining and forestry town, and also lowest capital intensity in the peer group. So highest grade, lowest capital intensity, closest to infrastructure. Those are all the boxes that one ticks in terms of future cash flows from mineral production. And so, look, we're very bullish on this. We are kind of the leading junior in the area, and we have an asset that, at this point, is a show me story. We get it. We were 2 years old, and I think the market's asking, well, what? How are you going to succeed where Rio Tinto and Panoramic sold off? I think those are fair questions, but I do believe that this project will be validated with a response from potential third parties that are, have their eyeballs on the project. Also believe that when we're in mineable reserves next year, at the conclusion of the pre-feasibility study, that in fact, the market will recognize the underlying value here. We traded about zero point 0.1 times NAV, so that is below where companies that normally that are fully validated would trade.
Mm-hmm. No, absolutely. No, you're right. I mean, and this is again what draws me. Same reasons you just expressed that draws me to this play. You tick all the boxes, right? Infrastructure, jurisdiction, management team, right? So, and this is the thing is that you've assembled, yourself included, a pretty strong team, right? And I guess one of the old cliches that I go back to is always been on the jockey, right? And so when I see kind of the resumes that you folks have, I think that again that's an absolute bolster to the narrative or the story that is clean air. Do you mind just running through your background a bit? I guess maybe in terms of maybe mines opened or kind of run through to mines run through to production, or and then also for your team as well.
Look, yeah, look, I think one of the biggest validators for us personally, or within the team, was the addition of Mike Garbett recently as chief operating officer. Mike is a mine builder of some repute, and he looked at the project before he joined, and it passed his sniff test. And so Mike, engineers want to build stuff, and Mike feels this is a deposit that can be built, subject to going through the whole pre-feas and feasibility study routine, which he's been through many times before. But he also welcomed the opportunity to work with our executive chairman, Jim Gallagher. Jim was formerly CEO at North American Palladium before the sale to Implats of South Africa in December of 2019 for $1 billion. It had a single asset, the Iles Mine, which is in full production today, 14,000 tons per day processor, 60 kilometers from the Thunder Bay North project. These two individuals are world-class mining engineers. Jim, for example, was a global director of mining for Hatch Engineers before he joined North American Palladium, and then joined Clean Air Metals shortly after the very successful pass to Implats. So from our perspective, we have a team that can build out a mine at Thunder Bay North, and we also have a technical team led by Dr. Jeff Heggie that is capable of finding more ore. Jeff was actually with the project during the days of Magma Metals, that was subsequently taken out by Panoramic Resources, who we ultimately effectively took out. And Jeff came back into the program through, Clean Air Metals is now our VP of Exploration. So it is ultimately, about the jockeys, the ability to move a project forward, but it's also very much about the asset itself. And I'll harken back to our news flow where, we have systematically over 2 years taken a raw prospect in the escape deposit and a fairly well established but troubled asset in current, and put them together to form a new mine plan. Now, when I say troubled, what do I mean? Panoramic's approach was open pit. On the high grade portions in the upper half of the current deposit, unfortunately, there was a lake in the way, and they would have had to drain the lake to put in the pit. 9-to-1 strip ratio. Being good Aussies, I suppose they thought, well, it's got to be a pit, and then underground out of the pit for the rest of it. At the end of the day, it was weekly economic at $500 palladium and $1,500 platinum. But the point was, it was not permittable. And so it ended up on the shelf, and we took it over, and we've turned it effectively into a ramp access underground deposit, along with the now very well defined escape deposit as well.
Mm-hmm. Yeah, I always find that interesting. Just back to the drawing board and restart from square one and rebuild and see what is the most economic kind of permutation and combination of pieces to make this work, right? Yeah. So you mean, just to sum up, you've got a geo Jeff Hagee, who knows your land package intimately well. You have Mike Garbett. You've got a mine builder who knows how to build mines and is on here because he believes this could be a mine and knows how to do it. And you've got Jim Gallagher, who's quite literally done. This is, I guess, just to take a step back. I always look for pathways to profitability as an investor, right? I mean, how do I make money off of this, right? And having someone like Jim, who is your executive chair, who he did this, right, just a few years ago. He did this all just a matter of a couple dozen kilometers away. He went through this whole process, and like you say, came out with it at the other end with a buyout of $1 billion, right? So this is not some sort of pie in the sky sort of wishful thinking fancy. Yeah, this is, like you say, very real. You're still in show me mode, but a very real and realistic opportunity for wealth creation, right? So
Yep, that's right.
no, awesome. Why don't you just help me out here? Can you just burn through, and I have these figures if you don't have them up, but just corporate structure, cash on hand, institutional support. Can you just kind of run through that end of things?
Yeah, look, from a capital balance sheet perspective, we have 222.9 million shares outstanding. We have about 4 million cash, and we are drilling. From our perspective, management owns and controls about 5% of the company. Benton Resources about 11% of the company. I want to give a little shout out to Benton. They were the ones who actually put the original deal together with Rio Tinto and Panoramic Resources, and they actually secured the sale of the escape deposit with a $3 million cash down payment from their own treasury, which got translated into Clean Air Metals stock, and that's how they became a significant insider shareholder. But 40% held by institutions. Some good names there, some solid support from Royal Bank Investment Management in their precious metals fund, Franklin Templeton out of San Diego and their precious metals fund, and also Sprott Asset Management in Toronto. So they've been there from the beginning. They've actually participated even in our most recent financing in February of 2022, where we raised $12.5 million as part of the $43 million that we've raised on the project since inception.
Excellent. And do you have any outstanding debt at the moment?
No, there's zero debt on the project, and from our perspective, it's we financing going forward. We'd like to look at minimally dilutive opportunities, and we believe those do exist.
Mm-hmm. Yep, absolutely. And just one more here. Any royalties attached to any of your land?
Yes, 3% NSR to the original prospectors. Who really were looking for diamonds in the early going. They control most of the payable portion of the current deposit. That's quite a valuable royalty. We do have the right to buy that down from 3% to 2% for a $1 million Canadian down payment, or at least cash payment at any time. We could pay it today. We could pay it after feasibility. We can make that payment. Then it becomes 2%. We also have a right, a ROFR, a right of first refusal on any commercial offer on that remaining 2%. In other words, we could match it and buy it out and retire that royalty. So that is a right that we do enjoy. Then Rio Tinto has a 1% on the escape claims, quite a small group of 15 claim units that contains the bulk of value on what is now the escape deposit. And they have a 1%. Benton has a 0.5%. Benton, in addition, has a 0.5% on all claims in the rather large claim group that do not have existing royalty coverage. So there's a 0.5% out there as well.
Okay. No, thank you very much. So just circling back to share structure here, 220 and change commons outstanding at the moment. You have about 61 or 62 million warrants, strike price for 55 million of them 25 cents, and then for about 6.5 million about 55 cents. Are you, when you do your financings, is it a full warrant finance? What's your strategy? I'm always curious here. Do you go for lower share price with a warrant as the sweetener, or what's your strategy with that?
Well, my strategy is basically take the terms that are offered. At the end of the day, look, these are the terms that were, like, for example, in February, we were offered, effectively a unit offering at 20 cents with a full warrant at 25 cents. That's ugly, but, we had no choice. I mean, at the end of the day, it was a little bit of a, they've been extraordinarily tough markets, as we know, over the last several months. Maybe things are starting to lighten up now, but we were 3 months ago, we were sort of 70 million market cap going to 100, and all of a sudden we found ourselves cut in half. Anything with a bid got sold off. So, I mean, the markets will ebb and flow. At the end of the day, we are price takers, and at the equity level, certainly, one of the things we can do with a project of this magnitude is entertain sort of an earn-in joint venture. Zero dilution on an earn-in and joint venture basis from a larger entity. That is the kind of thing that we are, sort of actively shopping around as well. Well, let's put it this way. We're informally shopping around. We've had some expressions of interest. It's not a process by any stretch, but we do see that as a way to keep the pressure off the equity.
Excellent. Yep. And so I'll give you an opportunity here. Last time we chatted on the phone, I asked you about insider ownership. That's one of the things that I think a lot of people look at is, it's always nice when the owners have skin in the game, right? And 5%, but the explanation you provided for me was, I thought, quite compelling. Do you just kind of want to run through why that is 5%?
Well, sure. I mean, obviously, Jim and I and Mike were recruited into the deal, and different board members. We all started from scratch.
Mm-hmm.
There was no founder stock available. What I mean is there was no kind of penny stocks floating around to incentivize, incoming management and directors. We bought every share we own at in my case, between 17 and 51 cents over the last 2 years. My most recent acquisition was a block of 1 million shares, fully reported to CDI at 17 cents. So, averaging down, as it were. Prior to that, my average spend was 35 cents a share. And, that's come down a notch here, probably into the high 20s. And, I'm comfortable with that. The value's there. I truly believe in my experience in the junior mining sector, and I've had a couple of M&As over time, that true value does ultimately, come to the surface. And that's where the jockeys become important, orchestrating that series of events that leads to a re-rating of a stock. And I think that we're on the verge of that here with Clean Air Metals. But Jim Gallagher, same. He and I own about the same number of shares. We bought every single share we own. There was no gifting of founder shares here at all. The underlying shell, which the deal was vended into and ultimately became Clean Air Metals, was halted. It was a shell called Regency Gold. It dated back to 1985. It was at the time a clean shell with $1.5 million, 25 million shares. We took over the board in February of 2020. They all resigned, and Jim Gallagher, myself, and Dean Chambers, who's still a member of the board of directors, recently reelected. We took over the board and brought the company back to trade in May, on May the 22nd of 2020. So that was the start of it. And the shell's gone. The shell has sold off. I mean, there probably was a ton of founder stock in that shell. That's all gone now. There was considerable selling pressure in 2021. What we're seeing now, I think, ultimately is, we'll see a series of steadily increasing lows as we go through the market cycle here. And if we get the validation moment that we're hoping for, a true validation moment where the market all of a sudden says, "Oh, so this is real," then we do expect the stock to re-rate, and quite frankly, we feel we should be trading based on comparables at a minimum 0.3 times NAV, which would put us into the 100 million market cap range.
Quite cleanly. I mean, I think it's an old, it comes to mind, that old Warren Buffett adage about, in the short term, market's a voting machine, in the long term, it's a weighing machine, right? And I think that, that the junior resource sector in general, and of course clean air, there's so many plays here that I think are just undervalued to the point of this being a very, very strong opportunity, right? And I guess I will say, like I said, I was on CDI just doing napkin math, so nothing precise, but you and Jim have spent over $1.3 million of your own money in the last year and a half or 2 years. So there's lots of reasons to sell, as they say, but only one reason to buy for insiders. So yeah, for my retail listeners who maybe see 5% and aren't sure about that, well, on the flip side of that, there's been a lot of personal capital put into this, right? So
That's
why,
right. Mm-hmm.
why don't we just skip around here? Tell me about location, right? It's kind of like real estate, right? Good mine, it's location, location, location. Tell me about neighbors, tell me about infrastructure, and why is this such a huge boon for you guys?
Well, as I said, 30 kilometers from the city of Thunder Bay, which is an active mining town, supplies and services 6 operating mines in northwestern Ontario today. Day in, day out, the multipliers from every one of those mines is 4 to 1 in the economy, in the broader economy, from each direct employee, 4 to 1, in terms of additional employment in the region. Very mining friendly, and quite frankly, I think your viewers will note that I took great care to call this the Thunder Bay North Critical Minerals Project. That ties into the provincial critical mineral strategy, the federal critical mineral strategy, which we do believe will positively affect our post-tax numbers to the upside. We believe that if the governments are serious about actually committing to a supply chain in Ontario to feed those new battery metal plants in Windsor, Ontario, and Kingston, Ontario, if they really do want that source of domestic supply, then they'll have to get a little bit creative with their tax policy. But the best part is Thunder Bay North doesn't need any change from the current tax regime to be successful. We have a strong, effectively mine plan and capital, capital summary related to underground production from two mines feeding a single mill. There's loads of potential upside here. We have that 14,000 ton a day processor up the road. Will they need feed? This is 10 years plus of new feed in the Thunder Bay mining camp, the Lake Superior Basin. There are two active mills operating. So look, there's all kinds of optionality here, but the beauty of it is we believe we can build it ourselves, and we believe with management of this pedigree that we can get it financed as well, potentially with the help of a senior partner to reduce risk. But back to your question about what about this area? As I said, look, proximity to infrastructure, peer leading grade, and lowest capital intensity in the peer group. When you talk about location, 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 I normally associate that with real estate, like
Yeah.
buying a house. And value on real estate is tied to location. I sat down with the former CEO of Goldcorp, Paul Williams, back in the day, and he was emphatic and banging the table on infrastructure, infrastructure, infrastructure. He said it's all about infrastructure. And in fact, he said, how it's location with real estate? It's infrastructure with mining. He's a mining engineer, and he should know. So we have a paved provincial highway crossing our mining claims. We have a 235 kV high voltage power line crossing our mining claims. We're sandwiched in infrastructure,
Mhm.
30 kilometers from a skilled labor force. We probably don't even have to build a camp here. It'll be a commute. And so lots to love, but probably the best thing of all these things I've mentioned is our relationship with the First Nations. The Fort William First Nation, the Red Rock Indian Band, and the band known as BZA or Binjitawabik Zaging Anishinabek, the former Rocky Bay First Nation. We're also talking with our Métis, the Métis Nations. There's two: the Métis Nation of Ontario and the Red Sky Métis Independent Nation. But these partnerships with Indigenous partners is absolutely critical to resource development in Canada today. And in effect, it's been said this way: the government of Canada and Ontario wants to undo, several hundred years of colonialism through inclusion in the resource development process. Number one, actually, that's number two. Number one is Section 35 of the Constitution says that Indigenous people shall have the right to, their traditional territories and treaty rights outside reserve areas, and it's the extent to which resource development projects could impinge on those rights is the extent to which we must meaningfully consult and accommodate, i.e., compensate. And so we've reached two agreements with our Indigenous partners, and the three nations that I spoke of, Fort William, Red Rock, and BZA, they are uber supportive here. They want this project to go ahead. And it is entirely consistent with their own investment strategy. These are investors in green energy solutions like run-of-river hydroelectric, solar, and wind. Put all that together, and this is going to happen.
Yeah, absolutely. No, thank you. That was
In
a
my
good.
in my humble opinion, subject to feasibility.
Yes, no, and I mean, I think that the ESG thing or whatever you want to call it. I mean, I think that sometimes we risk buzzwords losing meaning, right? But ultimately, and I believe in this, that local stakeholders, deserve a say or a seat at the table, right? And so, I mean, this is something that in my own research with you folks, you've done a very clear and sincere effort of incorporating and making sure that local Indigenous nations have that voice. And so, yeah, I mean, because for better or for worse, they have the power to disrupt any project, right? So why fight
Yes.
it? Why fight it when you can just work with it, right?
Well, look, I mean, traditionally, junior miners would run and gun. They'd come in and drill a few holes and get out before the communities knew they were there, so to speak, right?
Mhm.
That's, first of all, that's not sustainable, and certainly when one has a real project, one better be very proactive on the Indigenous file, shall we say, right? And I'm very proud to say that our three nation partners, and they're together in one agreement with us. Okay, so that's huge. And so, that in other words, they've been able to sort out their differences, come together for the good of this project, and they're calling it our project. This is their project. That's the beauty of it. And I said right from the outset, look, nothing would please me more than to see you and your joint venture partners running the whole outfit. That would be fantastic. And they're liking the sound of that.
Yeah, excellent. No, excellent. Just one thing I feel, just so I don't have any hanging chads here. Just for people that don't know, it's Impala Platinum, correct? That's the name of the company that's next door to you guys.
Yes.
Yeah, they are. Are they the world's largest, or what's one of the world's largest platinum producers?
With their operations in South Africa, where they're based, yeah, they are one of the largest platinum and palladium producers in the world. And certainly one of two South African entities controlling the major palladium sources of production in North America, the one being Lac des Iles, the other being Stillwater, with Sibanye Stillwater.
Mm-hmm. So
So
yeah,
the
not
South Africans have been here for years. They've seen the potential. And what are they doing but mitigating their risk factors back home?
mm-hmm. Yeah, not a bad neighbor to have anyway. So
Absolutely.
why don't you just talk me through just where your resource is as it stands, the numbers, and just where the depth of them. You talk about it being it's going to be an underground mine, switch from open pit to change the economics of it, and then just kind of what's helping guide your exploration in terms of geophysical or geochemical features.
Yeah, look, we're running sort of a let's put it this way. There are two conduits. These are magma conduits that are Proterozoic in age and rift related. And that's very similar to what you see at Norilsk in Russia, rift related Proterozoic, or at least rift related magma conduit style mineralization. Within those magma conduits, which are essentially high pressure erosional features into the country, much older country rock, they kind of thermally eroded their way into form these large, long, 3 mile or 4 kilometer long snake-like or serpent-like conduits. Within them, they have mineralization as kind of a last gasp of the intrusion process. In progressively more ultramafic rocks, peridotite, into which came the copper, nickel, platinum, palladium mineralization in what we call peridotite rocks. And so that's the start of it. And these two conduits are mineralized from stem to stern, from the top to the bottom. But the bulk of the drilling at current, for example, has been done in the top half of the deposit because although they are subhorizontal in nature, they are slightly inclined. And at the top, where the highest grade mineralization is, you're about 70 meters below surface, easily accessible, ramp access. At the bottom, you're about a kilometer below surface. Not as much drill density down there, but the system is open. And we believe that although we have 10 years of well-defined feed today, we believe that this is a project that will likely replace reserves as production continues from going progressively down plunge and perhaps accessing the ore or at least drilling off the ore from exploration adits, which are much closer to mineralization than from surface. So, but look, we have 22 million tons of mineralization, of which about 12 million tons is mineable as of today, based on the cutoff grade, and that effectively, on initial capital of 367 million Canadian, we have fully discounted cash flows over that 10-year mine life of $425 million with a 31% internal rate of return on initial capital. Okay, so that 12 million tons runs about 8 grams, sort of platinum equivalent in situ. In the first 4 years of production, it's actually over 10 grams. It's extremely high grade and relative to our peers, and quite frankly, quite a good margin there.
Yeah, excellent. I mean, your resource as it sits, and I'll let you clarify this for my audience, but it's about 2.3 million ounces platinum equivalent of net mineable resource. Correct? It's not in situ. It's not just in the ground raw prior to recovery rates, but you have 2.3 million ounces platinum equivalent uh, of
Payable.
payable. Yeah, so that that number is meaningful, right? And this is not you step in there if you want, Abraham.
Well, that's right. And so from the in situ resource that I mentioned, you have ultimately, as you mentioned, Matthew, 2.3 million ounces of platinum equivalent payable metal. So that's the metal ultimately net of mining dilution and mining recovery, net of metallurgical recoveries, net of smelter payables. You net out your payable metal, which runs about 1.3 million ounces combined platinum, palladium, and quite significant copper and nickel as well. Roughly, sort of 150 million pounds of nickel and about 80 million pounds of 150 million pounds of copper and 80 million pounds of nickel, and indications that rhodium and cobalt may ultimately be part of the payables mix as well. In the first round of metallurgy, we were not successful in bringing them up to the minimum concentrate grades required. But now that we've hired DRA Global, the South African metallurgical engineering company, we are focused on adding rhodium and cobalt to that mix, which would be straight to the bottom line. And we're pretty excited about that whole optimization process.
Yeah, rhodium is on my list down below here. We'll get to that because boy, that's I think it's $14,000 an ounce right now or something close to that. So boy, it would be an awful nice little bonus to unlock anything there, right? I mean,
Yes.
I just wanted to kind of circle back here. Um, the like you say that the payable ounces is such a critical distinction because I think when people look at 43101s, that a lot of the time that the pounds in the ground you see they don't account for NSRs, right? They don't account, even some of them I see don't even account for recovery factors. uh, I think I mentioned this closer to the beginning, but I mean, you have had Clean Air has gone through fairly stringent, I mean, bulk sample testing. You've done your met testing, and so I mean, the numbers that you provide are hard, scientific, honest numbers, right? And I mean, we can maybe circle around to these or come back to it quickly, but I mean, your recovery rates are pretty respectable, right? 85% plus for platinum, palladium. Everything else, the only one that kind of is a weak sister, if I can call it that, is nickel at 52. But you have a real science based plan for production or for recovery, and you account for that in your economics. So I just appreciate that that's where you're coming from that perspective.
Yeah, it kind of falls out of the analysis that was done by the third party independent engineering group Nordman for the PEA, and now we've hired another third party engineering group DRA to do our metallurgical optimization as a starting point. The next announced this morning in our in our most recent press release here on August the 2nd, that we've also hired SLR, the former Roscoe Postal people, same team. They got taken over by SLR, and now they're SLR Toronto, and they will be doing a validation of a mineral resource update. There are approximately 55,000 meters of drilling not yet in the mine plan from the escape deposit alone, and about 6.5, close to 7,000 meters of infill drilling at current, not yet in the mine plan. The significance of that is that it may very well push, that 10-year mine plan to sort of a 12 to 13-year mine plan, and push the tail back, out past 10 years, and just improve the overall economics of the project. Um, through the metallurgical optimization to improve payabilities and concentrate grades of all the commodities, but also a model that is much tighter now with all the infill work that was done since the resource update of January of 2021, on which the mine plan, the present PEA mine plan, is based. It doesn't incorporate that extra drilling. The PFS will, and we think it just gets much more. We know it gets much more robust, but all those results have been reported into the market, but not yet worked into the model.
Mm-hmm. Well, and I think this circles back nicely. You discussed that you're trading at zero point 0.1 nav, which is just silly, right? I mean, peers 0.2, 0.3 nav is typical, right? I mean, and knowing on top of that that you've got over 60,000 meters of drilling unaccounted for, just not even existing yet. That I start to see dollar signs, I guess, right? That's where I'm
Well,
at.
look,
So.
I mean, I take a sanguine sort of approach to this. I've been involved with a number of junior mining deals in a senior executive capacity over the last 20 years. And then, in the bush, swinging a hammer as an exploration geologist for 15 years before that. But look, as I said, I've had a couple of M&As that, they start slow. It's, the story gets built, and I've developed, I think, a bit of a personal reputation, but it's also just being careful going into a deal of being involved with quality assets. Thunder Bay North is the latest example of it, but, Carlisle Goldfields with the Lynn Lake Gold Play, M&A with Alamos Gold, they're going to build it. They've got a positive feasibility study. It's a real play. It's a real asset. Uh, you know, uh, Alamos will tell you they got it for a song, but here's the point. The day that we announced the deal with Alamos, the 25 cent Carlisle went to 64 cents for starters. Then that was an all-share deal done with Alamos at 480 in 2016, and they went to 13.50 that year. So 25 cent Carlisle actually went to $1.50 Carlisle on that basis. So it was a great and again the value came out, and by George they're going to build it. Then there was Premier Royalty, where we accumulated half a dozen cash flowing royalties in a year and a half when royalties still were not well understood, and about 20 to 30 geological bets. And the whole thing got taken out by Sandstorm Gold within under 2 years. And on the basis of the quality of the assets we had accumulated. And some of those assets today are their top performing cash flow producers at Sandstorm Gold. So look, we've been doing something right, but it always starts slow. And then there's a re-rating based on some sort of unique event. And we think that we're getting close to that with Clean Air Metals now.
Mm-hmm. So I guess I'll want to ask this. This is a fairly boilerplate retail investor question. Is so, and this is a lead into a larger conversation. But how many meters drilling are you doing this year? What's your plan?
Um, Yeah, look, we because of cost overruns due to price of diesel fuel, we've trimmed the sales a bit. We're drilling with one drill. We've had two drills operating continuously for 2 years. Effectively to get the meterage in and go to a pre-feasibility study. We have the luxury now to be able to cut back to one, 24/7, 365. We're spending with drilling, with engineering studies, and with environmental field work. We're spending about $1 million a month at the moment,
Burn rate. Okay.
and that's all in, including G&A as well, which is salaries, legal fees, and accounting fees, and all that good stuff.
Mm-hmm. Can you drill 12 months a year where you're at?
Oh yes, yeah. In fact, the best time to drill is in the winter when the ground is frozen and you can go anywhere.
Yeah. Yeah. So I guess my ultimate question from that is so you can't just drill forever, right? I mean that ultimately you have to kind of plant your flag and say this is our resource, this is what we're going to take to PFS. So I guess maybe my ultimate question is how much more drilling do you foresee happening prior to PFS, and when might we expect PFS to be released or to start to occur?
Yeah, look, the PFS is in progress now. It's on target to be delivered, sort of end of next May, early June, sort of late Q2, early Q3 next year, with all the component parts being compiled and reported. And then between now and then, that's what shall we say, 10 months away. We're drilling 5,000 meters a month, so that'll be, with infill drilling and exploration targets, another 50,000 meters of drilling, I would expect. And, but only a portion, like I would say half of that will be incorporated into the actual pre-feas, because there is a cutoff date on which mine planning must take place. But, again, if there's material changes, such as a new discovery or what have you, I mean, that would be incorporated then potentially into a feasibility study. We do have some very, very exciting exploration targets outside the production area.
Yeah, but like you say, just not mature enough and not ready for the PFS. No, absolutely.
Right.
Well, let's crunch some NPV numbers right now. Your numbers are very compelling. They're obviously leveraged to price of palladium, price of platinum, and I want to kind of run through briefly in a moment here, kind of the bull and bear case for those two, and why I think that I think sometimes people get caught up in narratives, and the narratives take longer to realize or to kind of to come into being. But that reality and narratives don't always match up, right? So I think that there's there's a conversation to be had there about that with palladium. But your numbers are strong, very strong. Very strong, so long as palladium platinum stay up. But like I say, just sidestepping the discussion on bull bear cases for those two for the moment. What are your plans? How can you improve the economics? I mean, do you have plans for? Is there a potential for reduction of OPEX or CAPEX that you're looking at, or do you have any plans to help improve the economics of your project aside from just?
Yeah. Well, let me comment on metal prices. We use the CRU 2-year trailing average price deck to generate our economics. I believe we will be consistent as we move forward. It'll be the 2-year trailing average price deck. And I think the price of palladium will have come off a notch from 2,200 the first time through. And probably with some of the volatility we've seen, it might be sort of in that 2,000 to 2,100 range. Platinum has been fairly consistently depressed in that sort of $850 to $1,000 range for several years post Dieselgate. But I will say, when the first PEA was done on the project here in 2011, based on the open pit model, platinum was 1,500. So I mean, it has some runway here, we believe. And in fact, if you look at the forward curve for platinum based on the hydrogen revolution here and the expected demand or a supply shortage that's looming in the platinum market, sort of from here to between here and 2030, we could see similar price action in platinum as what we've seen in palladium. The palladium piece, look, all systems are go right now at Nornickel. What if Nornickel got shut down on the next round of sanctions? What if they can't resolve their differences, overseas there, and things really hit the fan, so to speak, and certain voices win the day and say, well, let's shut down the mines there. We're not accepting any more palladium from this jurisdiction. It's at that point you need to shut down but for the supply that's still in the system, which isn't much. Palladium's in a supply deficit. You shut down the North American car industry. So at that point, we truly have cut off our nose to spite our faces. What if that happens? Then domestic sources of supply, of course. You mentioned rhodium at $14,000 an ounce. I mean, it's not, in the average car right now, there's $200, $200 to $300 worth of palladium. Let's put it this way. Of platinum, I should say. Palladium, there's usually about 5 grams, and a gram goes for sort of 50 to 75 a gram. So you're looking at somewhere in the neighborhood of $300 to $400 per vehicle in a catalytic converter. That's not a deal breaker. Okay. Where does it become a deal breaker? At what point are companies actively looking for replacement? What's the obvious replacement? Well, quite frankly, platinum was always the metal of choice in catalytic converters before the chemistry, before palladium became the replacement, and the chemistry was developed around palladium. So, look, anything can happen, but at the end of the day, we're very, if you're talking about building battery metal plants in Windsor and Kingston, Ontario alone, not to mention the battery metal plants that are going into production in the United States, the question really becomes, where's the supply coming from? We need to remember these are not theoretical changes to, the EV transition is not theoretical. It's structural. It's actually regulated. It must occur by 2030. And furthermore, if gasoline engines, in order to stay in production and to produce a fossil fuel burning vehicle, the loadings of palladium and platinum and rhodium will only increase. So there's a lot of pressure here on to the upside on the battery metal suite. And copper nickel, of course, need no further introduction in terms of conductivity and battery applications. So we feel pretty sanguine about it. We know there's volatility in the world. We believe the 2 year suite. We believe that quite frankly, we're duty bound to continue to use that 2 year suite to be consistent, so that we can compare apples to apples all the way through. And look, we think that we were very, very conservative on ultimately on copper and nickel pricing in the price deck relative to current world pricing. Copper's come off a bit. Everything's been under pressure, but these are structural requirements. They're not going away. They're regulations. And that supply chain will drive value, or lack of supply in the supply chain will drive value as we go forward here.
Mm-hmm. Yeah, just for the sake of my listeners, post-tax NPV at current prices is about 293 million Canadian. That's what you have in your 43101, and that's fairly consistent with what we see today's prices at. And then yeah, you have your price for copper. What you've quoted it at is 309 US, and I think it's last I saw 350, 350, 360 somewhere in there. So yes, yeah, absolutely. And then of course nickel. Your 2 year trailing average nickel has obviously gone through the roof here the last 6 months or 12 months, 686. And so, I mean, I'll just say this. I mean, you have this polymetallic deposit, and then so long as the met testing comes back positive, I love polymetallic deposits due to their optionality, but you've got almost $5 billion of metals in the ground, right? I'm just kind of scanning through here, the things that, you've got almost $2.5 billion worth of platinum palladium, but then, $600 million of nickel, $500 million of copper, things that, and this is where I talk about optionality, and this is me just theory crafting, so feel free to poo-poo it. But I look at, and you'll excuse me if I compare you to another developer, but Generation Mining, I thought they did such a good deal with Wheaton, and sometimes streaming can be a bit of a poison pill to take sometimes. But they streamed off what was a minor metal to them, and they got $250 million to help build their mine, right? So I think that there's so much flexibility, and I guess is my point, that why I like these polymetallic deposits, so much flexibility in terms of how you work your economics and options for you, right? So
Look, yeah, I mean, the Wheaton precious metal guys are one of a number of streamers in the industry. I think what Generation did there was recognize what's become quite a conventional form of financing in the business now. I will say, for example, I believe that streaming deal for 240 million with a $40 million down payment was based on the platinum and the gold in the Generation or in the Marathon PGM deposit controlled by Generation Mining. And we have both in our deposit. In fact, on a contained metal basis, we have more platinum at Thunder Bay North. So look, do we have potential to do a streaming deal? Absolutely, we do. Is today the day to do it? No, it's not. You need to be that much closer to cash flow to avoid the penalty of the time value of money. You do it when you're doing construction financing. You do it when you've got feasibility numbers, and effectively, you also do it with elements that are not going to that are byproduct constituents in your deposit that are not going to affect your main cash flows. But it is a very effective way of financing projects in this day and age.
Mhm. So why don't we just skip back here? We'll try to wrap it up here in the next 5 or 10 minutes. But the bull and bear cases for some of your core metals. I think that palladium, and this is where I talk about sometimes narrative outracing reality. If you were to talk to average investor on the street, they'd say, "Oh, palladium, oh, that's a dying market." Catalytic converters, ICE engines, internal combustion engines. They're not. It's a way of the past, right? That the green revolution's upon us. But if you look at the compound annual growth rate for ICE vehicles, that's still 5 to 7% to 2030, right? And so, yes, the green revolution is upon us, but I think that we are. It's extremely remiss to assume that these transitions just happen overnight. This is a matter of decades, right? That these things take place on, and so I guess maybe this is less a question for you and just a comment for me, maybe, but just that palladium, there will be strong, consistent demand, and that's discounting geopolitical realities, right? But strong, consistent demand, for the next foreseeable future, right?
Well, look, I should point out that Thunder Bay North has equal parts platinum and palladium. It's a
Mm-hmm.
1-to-1 ratio, and that's actually quite rare. For example, at Lac des Îles, it's 1 part platinum to 10 parts palladium, and similarly at Marathon PGM, the ratio is not 1-to-1. We have 1-to-1, so we have good optionality here. I don't disagree, and the one thing that does concern me, I guess, with respect to ICE vehicles, internal combustion engines, is that some governments have actually mandated no more production of new vehicles after certain dates. And they get stupid, like it's 2030, 2035, 2040. I mean, I believe the European Union has actually put some limits on that. So that may be ultimately, what shall we say, a choke point on demand. However, if indeed you've done that, then you are assuming that other technologies will be brought to bear. Otherwise, are we truly saying that we will no longer have an economy? No, we're not saying that at all. We're simply saying there'll be alternate technologies, such as hydrogen fuel cells, such as battery electric. Battery electric is a fantastic technology, but hybrid electric, for particularly hydrogen hybrid electric, is another one that uses exclusively platinum in the anode and cathode of the electrolyzer to form green hydrogen from renewable energy sources like wind and solar. You can use hydrogen as a battery, effectively as for base load. In times when the sun doesn't shine and the wind doesn't blow, you've got hydrogen in storage. Or you can use that hydrogen in a fuel cell where oxygen and hydrogen are recombined in a fuel cell in a vehicle to release an electron and water out the tailpipe. And that electron goes into a battery, which is is still, so the battery technology is still every bit the same. Now, in a hydrogen fuel cell vehicle, the batteries are smaller. There's not as much weight, and that becomes important in high bulk tonnage transportation applications like trains, planes, ships, buses, etc. Where the research suggests that battery electric's not the way to go. You've got to have a fuel cell with a much smaller battery so that you can maximize your payload, and it's much more efficient. But for retail, commuter traffic across town and back and forth and plugging in at night, battery electric on its own is just fine. But so there will be multi-partite solutions here. They shut down production of ICE vehicles by 2030, 2035. You got to know that that void has to be filled by some other metal. And the beauty of it is we have that platinum in a 1-to-1 ratio, and we also have copper nickel. We also have rhodium and cobalt. And as the price goes up, those become just that much more valuable to our product mix. So, if the palladium's ultimately a dying metal, as some say, then of course, I suspect that slack will be picked up by others in the multi-commodity mix.
Mhm. Well, and like I say, I strongly suspect that any runway to the decline of palladium demand is longer than we're anticipating as is. But I guess that's
Well, I think governments can change their minds. There's no doubt about it.
well, and I think what you say is actually puts it quite nicely because it dovetails in, platinum, palladium. You have a metal that we need presently now desperately in palladium, but then also, like you say, 50-50 mix where you have platinum, which is a kind of a metal that we'll need into the future with hydrogen fuel cells, right? That I just was doing some light research here, and now, of course, this is a tiny sector of the market, but I think it shows you how potentially explosive hydrogen fuel cell that sector could be, or that industry could be. They're expecting this is now vehicle sales. So there's about 15,000 hydrogen fuel cell vehicles sold globally in 2021, and they're expecting that to 10x by 2030. Right, and so, and then you can correct me here, but my understanding is that there's about 50 grams of platinum that goes into every vehicle, every hydrogen vehicle, and so you see like that's 250,000 ounces in 10 years of additional demand. I mean, globally, like platinum and palladium is a tiny, tiny sector, right? There's not a lot of ounces that get produced every year. That's a substantial increase in demand, right? So, yeah, you have metal that we need now in palladium, and then you also have a metal that we will need into the future. So you kind of have like the whole market cornered a bit, right?
Yeah, and in fact, if you add in bulk transport into those numbers, the deficit, gets even higher. Simply because, if you're now building fuel cells that can power mining trucks, buses, trains, planes, and ships, battery electric doesn't cut it. Your standalone battery electric, the weight of the battery basically eliminates your payload. Okay, you can't build batteries big enough, and so ultimately you need something in the tank. You need a much smaller battery with a way of producing electricity in a carbon-free manner. Hydrogen seems to be that solution, and there are some very big names and research dollars that are getting into that game. And so you're saying 250,000 ounces?
Mm-hmm, mm-hmm.
I mean, the numbers I've seen is like 3 million ounces, sort of in deficit by 2030. So based on those bulk transport applications. So yeah, I mean, and I will say this: all the big research now. I mean, it's proven technology. Hydrogen fuel cell. You can buy hydrogen at the Shell pump in Vancouver today, but we believe it'll scale up and spread out across North America, Europe, and Asia, where it's already quite well developed. But the real research is in bulk transport, and even Los Alamos Laboratories in the U.S. of Oppenheimer fame. That is one of their principal research projects: is hydrogen fuel cells for bulk tonnage applications,
Mm-hmm.
transportation solutions.
Mm-hmm. Yeah, no, lots of change
And,
coming.
Johnson Matthey. Johnson Matthey are the guys who predicted in 2016 that palladium would go to $2,000 an ounce. It was 500 at the time. There was one or two groups that actually believed them, like Neil Froneman at Savanier Stillwater. He bought the Stillwater complex at that time. Everybody's going like, "What? What just happened?" And of course, 3 years later, he's a hero because indeed Johnson Matthey was right. Johnson Matthey today is all in on PGEs, all in.
Hmm.
They've actually gotten out of the battery metals business, the copper nickel. They're all in on PGEs. And you got to ask yourself on what basis, right? Well, some of what we've touched to discuss today is part of that rationale.
Hmm. And just moving forward here, to respect for your time, I mean, and just so the listeners, I mean, they've probably figured it out by now. I've mentioned it prior, but all this time on palladium, platinum. But I mean, yeah, you have well over $1 billion in nickel, copper too, right? So there's just all sorts of and recoverable, you know,
Payable, yeah.
payable dollars, right?
Yeah.
So, and then
Oh
even
yeah, and you mentioned nickel recoveries. Interesting. One of the realities in the nickel mining business is that nickel is actually found in two forms in the average deposit. One is in sulfide form, which is the form you want for battery electric applications. The other is in the silicate form, which is not recoverable. And the silicate form of nickel can be up to 40% of your nickel. So when we say 52% nickel recovery of total nickel, we're actually saying 52% of the sulfide and the silicate nickel. But if your sulfide nickel in our case is 60% and you're getting 52%
Mm-hmm.
of 60%, you're actually getting 85% nickel recoveries of your available nickel, right?
Mm-hmm.
So we're reasonably gratified with that first round approach. If we think if we can improve that up to where copper is at 95% recovery, that would be significant. But really, if we can take our PGEs into the 90% range from 85, keep in mind lactazile is at 82%. If we can get it into 90% range and bring in rhodium and cobalt into the mix, that's going to make a big difference for us
Mm-hmm. Well, yeah, and
to
that
the upside.
yeah, absolutely. That rhodium. I mean, again, this is just napkin math, so I don't pretend to know that it's accurate to the 99th percentile. But I was looking up that other companies use $15 because it's such tiny amounts. I think that you have zero point zero 0.05 grams per ton is what you're measuring in your deposit. That other places they measure it in dollars per ton. Rhodium is new to me, so this is just me learning as I go, right? But $15 ton cutoff. I mean, if we so for you in the ground, if we assume that, again, recoverability factor of 100%, which of course isn't realistic, but that's over 300 million American dollars in rhodium if you can actually unlock that, right? So yeah, just
Well, it
as
would be nice. That's what we call a sweetener. It would be straight to the bottom line. It would help. We have stopes in the upper portion of the current deposit which run 1 to 2 grams rhodium. There's some extraordinary high grade here. That's not the stuff that goes into the metallurgical testing because you want average run of mine grade. But we're actually breaking out years 1 to 4, years 5 to 8, and then beyond into 3 separate metallurgical tests because you've got time after years 1 to 4 to really fine tune your process for the next phase, right? But if we can make rhodium and cobalt payable in that first 4 years, that will help a lot.
mm-hmm. So I guess just maybe we'll cycle back to kind of transition into the end here. Do you mind, just it's a question I ask everybody, right? What's the biggest risk or unanswered question currently facing clean air? And then I guess what facing you, what's the biggest risk or unanswered question facing you that might prevent you from a successful outcome to this project?
Um, well, I mean, in at the board level, there's something called key man insurance. I mean, if we were joking about it recently, and but it's no laughing matter. I mean, companies do keep executives off the same aircraft, for example, for a reason. If but barring any unforeseen sort of loss of key members of the management team, look, with any junior mining company, it's about financing risk and it's about commodity price risk. We believe that with our First Nation partners on board here, the regulators are going to be falling over themselves to issue permits on this one because they want the jobs. It's 600 construction jobs, 200 mining jobs in an active and ongoing basis. You got the support with little opposition or no opposition, those permits will be granted. But no, I mean, look, financing risk, commodity price risk, those are the big ones.
Yeah, fair enough. So do you have any words of advice for retail investors in the junior space? I guess even within the context of kind of difficult times, if you want to take it that route, but otherwise, just what does it take to succeed in this sector?
Well, I mean, look, I mean, I read Frank Juby once wrote a book, about the discovery of uranium in the Elliott Lake, sort of uranium fields, and he made a statement in there. He said, for people in the business, geologists who could actually uniquely appreciate the news that's coming out, if they're not doubling their or 1.5 times their salary again, like 50% more than what they make in their salary, they're doing something wrong just by listening and deducing that, yeah, that's real and going. So ultimately, though, I think for the retail investor who's not necessarily versed in the geosciences and so forth, Look, yeah, I mean, do the research, but you have to have a feel of what's real.
Mm.
And and I think that to some extent that's instinctive. And I mean, certainly with mid tiers and senior mining companies, you can assess cash flows, you can read analyst reports. But I would say with juniors, it's you've got to have the feel for it. You've got to know the management better have a track record, and if there's independent research coverage, that's also then at least you've got that third party validation as well.
Mm.
And I think, in the case of Clean Air Metals, we're covered by Beacon Securities, Echelon Wealth Management, and also Paradigm Capital at between 80 cents and $1 a share. So that's their three analysts weighing in. And then over in London, Hanneman Partners at 60 cents a share. We think, and that would re-rate us effectively to sort of zero point 0.4 NAV, which is still in the range of where we think this project has the potential to re-rate to.
Yeah, I think that's sage comments, right? Never stop learning. It can be a very steep learning curve. So just never, you kind of have to go back to school. If you're a layman such as myself, you really, really, really have to be consistent and dedicated to overcoming ignorance, right? Uh, Parting thoughts, final words.
Well, look, thanks for the opportunity, Matthew. I think it's a great chat. Might be a little long for some folks, but in any event, all the best with your wife's birthday, and thank you for the time.
Yeah, thank you. Yeah, thank you, Abraham. I appreciate you coming on. Thanks to our listeners. Right, if you wanted more information on clean air metals, please go to cleanairmetals.ca, just as you would expect it to be spelled. And you can find me under the name Junior Resource Investing on YouTube, Spotify, and elsewhere. Again, Abraham, thanks for coming on the show.
Thanks, Matthew, for the opportunity. I appreciate it.
Have a good day.
Bye bye.